Hey traders, in today's video, I'm going to show you how you can use leverage to trade with $500,000. And I'm going to show you how to do it, but I'm also going to tell you why you shouldn't. And for those of you who do get this $500,000 of buying power, I'm going to show you how you can use this power the right way. This video will show you every single thing you need to know when it comes to leverage and margin trading. And for a lot of traders, even if they've been trading for a while now, this complex concept is a bit hard to grasp, but you guys already know, the ones who watched this channel before, you guys know I'm going to explain this in such a clear-cut format, simple enough for you guys to understand this concept. So make sure you have your pen and paper ready, take some notes, and feel free to kind of skip back into the video if you have to rewatch a certain part of the video again. So if you guys do like the sound of that, go ahead and hit the like button because it really does help out the channel, and let's go ahead and get started. And by the way, if you're not subscribed to this channel yet, we put out content like this multiple times a week, so you definitely want to subscribe and hit that little notification bell so you can get updated and alerted whenever we do upload new videos on the channel. Now, that being said, let's go ahead and talk about what leverage is and explain to you exactly how you can use it for your benefit and what the potential dangers are. So the first thing we need to understand is the fact that the Forex market, as we know it, would not be possible for normal everyday people like you and I to be able to trade in if it was not for leverage. The only reason we're able to trade the market today is because brokers allow us to get this leverage. If it wasn't possible for leverage, it would cost too much of capital of money for us to see even any potential gains in the Forex market itself. So because of leverage, we're able to have profits that are big enough to be able to make it worth it for you and I. So how leverage works is, let's say you open up an account with a broker, right? So I want you to consider the broker as like your bank, right? Someone who's willing to kind of front you money in order for you to enter specific trades. So if you had a broker that gave you 1 to 10 leverage, let's just say for this example that you're willing to put up $10 as collateral for the broker to enter a trade for you. If you had 1 to 10 leverage, the broker will say, okay, give us the $10, we'll hold it for you, and then we'll give you 10 times that money to be able to go into a trade. So $10 times 10 leverage will give you $100 worth of buying power. If the broker that you went with had 1 to 20 leverage, you give them the $10 that you put up that as collateral, and they give you 20 times that as buying power. So that broker gives you $200 of leverage. Or if the broker is 1 to 50 leverage, that's giving you $500 just for you putting up $10. And if you went with a broker that gave you 1 to 100 leverage, you put up the $10 as collateral, and the broker fronts you $1,000 to enter that trade. And 1 to 500 leverage, same thing. The broker says, all right, give us $10, we'll hold it as collateral, and we'll go ahead and enter a $5,000 position for you on your behalf, as long as you have at least the $10 in your account balance to allow us to kind of hold as collateral. So that's kind of how you would use leverage. And that's how leverage works, to allow you to trade with more money than you're actually putting up into that specific trade. Now, that sounds great, right? You say, oh, wow, I just need to put up $10 and the broker's literally going to allow me to play with $5,000. That's amazing. I can literally do this all day. I can trade with millions and millions of dollars. So this is where things kind of start going south. This is where brand new traders really don't fully grasp the concept of margin or leverage trading. They just get excited to see that they're able to trade with a huge amount of capital, even though it could be very dangerous as well. So let me kind of explain to you how using leverage the wrong way can really affect your account. So let's just assume that you had an account balance of $1,000, right? And for this example, let's just assume that you're using a broker with 1 to 500 leverage. And the reason I am using a broker in this example with 1 to 500 leverage, because most people that do trade, most people go with unregulated brokers, which give their customers 1 to 500 leverage, because it's appealing for a lot of brand new traders. So let's kind of use that as an example. So let's say you have $1,000 in an unregulated broker account, and they're giving you 1 to 500 leverage, right? So you take out your calculator and you say, okay, I have $1,000 in my account. What's my total buying power? So how do you calculate that out? You take $1,000 and multiply it by 500 leverage. So that means you're able to play with $500,000. So a lot of brand new traders, they say, wow, That's 500 grand I can literally put into a trade, even though I'm really risking only $1,000. And this is the completely wrong way to think about it. But I can see why people think this way. If you remember from one of my previous videos, matter of fact, I'll link it up here if you haven't watched it already, I explained to you how much money, how many units of currency is one lot worth of trading. So if you remember, one lot is $100,000, right? So that would mean 2 lots is $200,000. So in this case, if you have $1,000 with 500 leverage, you're able to play with $500,000. That means you could potentially enter a 5-lot trade. And if you guys remember from that same video, again, I'll link it up here. If you guys remember, so let's kind of go back. A 1-lot trade would be making or losing $10 per pip, right? If the price goes in your favor by 1 pip, you're making $10. If the price goes in your favor by 4 pips, you made $40. So a 5-lot trade, that would be $50 per pip, right? So a lot of traders look at that and say, wow, if I make $50 per pip and the trade goes in my favor by just 10 pips, 10 times $50, damn, that's $500 I can literally make with just 10 pips movement. And yes, that sounds very appealing because if the price goes in your favor by 100 pips, guess what? 100 times $50, that's 5 grand. So you can make 5 grand with just 100 pips movement in your favor off of just putting $1,000 collateral. So here's what most people do. They will go open up their account with $1,000. They'll go into a trade. They'll just max out their leverage. They'll max out the lot size, do the biggest size they possibly can, which in this case would be 5 lots. So let's say they entered USD/CHF and they entered a trade with 5 lots, going 500,000 units deep into that trade. But what people don't realize is what happens if the trade goes against you? Remember, each pip that you're losing, that the trade goes against you, you're losing $50 per pip. So if that trade ended up going 500 pips against you, for example, you would literally be $25,000 in the hole, literally in debt. But luckily, brokers don't allow you to even get into that big of a debt because they have what's called a margin call and a stop out level. So what's going to happen actually in your case, what's going to happen is if that trade goes down 2 pips, you're now down $100, right? But what if that trade goes down 20 pips? You're now down $1,000. And at that point, you've literally blown your account. Because what's going to happen is the broker's automatically going to stop your trade, close your trade out because they don't want you to owe them money because they know for sure most people are not going to pay the money back. So what they do, what these brokers do, they just cut off your losses if the trade goes maybe 10, 15 pips even against you. So that brand new trader, super excited, only looking at the upside, doesn't realize if the price goes against them, it's real money that they're losing. So when they had that $1,000 in their account, if the price goes against them, that $1,000 gets wiped away, and now they're left with pretty much pennies or peanuts. So yes, being able to trade with the $500,000, it's definitely possible, and you could do it, but if it goes against you by just a small amount of pips, your whole account is wiped away. And this is why that's the wrong way to go about leverage. And by the way, having the 1 to 500 leverage, that's not bad. I'm not saying 1 to 500 leverage is dangerous or bad. You just have to use that leverage the right way. US regulated brokers only allow a maximum of 1 to 50 leverage because they don't want brand new traders blowing their accounts too quickly, like the example that I just gave you. However, unregulated brokers, to make it appealing to kind of sign up for that brokerage company, they allow you to go up to 1 to 500 leverage or some even higher. But that shouldn't be an issue. That high of leverage shouldn't be an issue for you if you are using leverage the correct way. That 1 to 500 leverage could be a beautiful thing. You just have to make sure that you're making the right decisions and not doing stupid things like I just mentioned. Because if you are doing that, then you're like gambling in the markets.
Stop it. Get some help.
So let's talk about the right way to do this. And by the way, this is just my opinion. I'm not a financial advisor, yada, yada, yada. This is just for entertainment purposes only. I hope you guys are getting entertained, right?
Are you not entertained?
So this is what I would do. So let's just say that you do have that $1,000 account. And let's also say that you're with a broker that gives you that 1 to 500 leverage, right? So the way that I would do this is I would look at my account size, which is $1,000, and then I would say, okay, how much am I willing to lose? How much money am I willing to risk if I am wrong on this trade? If my analysis is incorrect, how much money am I willing to part with? So I would think about it. Okay, so out of my $1,000 account, what percentage am I okay to lose? I'll say, okay, maybe I'm okay with losing 2% of that $1,000 account. How much money is that? That's 20 bucks. So I can say, all right, I'm willing to lose 20 bucks on this trade if I'm wrong, but if I'm right, I'm wanting to make 40 bucks or 60 bucks or 80 bucks or whatever it is on this one single trade. So now that we know how much money that we're willing to risk, now we need to figure out exactly what our lot size, our trade size would be in order to be able to lose that $20 of our account. And how would we do this? We would do this by looking at the actual trade on a trade by trade individual basis and kind of see what we need to do in order to determine how far our stop loss should be. So let me kind of explain this for a second. So the currency pair that I'm looking at right now is USD-CHF, which is the United States dollar versus the Czech franc. And the trade that I'm about to show you here, I've explained in detail the same exact strategy on how I'm going to show you this trade in one of my previous videos where I show you what the best and easiest way to trade for beginners in 2021. So if you have not watched that video yet, I would definitely suggest you click the link right up here and watch that video after you're done with this video here. And matter of fact, every single video that I mentioned during this video here, I'll link all those videos down below in the description. So once you're done with this video, scroll down, click the link in the description, and you'll go to the other video that I'm talking about here so you can understand the full strategy and how to trade this specific way. So just to give you a quick little recap, let's assume that you're like way over here and you notice that the lows are getting higher and higher and higher and higher and higher. And also you notice the same thing, that the highs are getting higher and higher as well. So you could possibly be thinking that this could be going in an uptrend. Or in other words, you could be looking for buys, looking for areas to go long, right? So again, what I explained in that previous video was what you would do is you would find areas where there are the peaks, and you would go ahead and draw a zone at these resistance areas, and you would extend these zones all the way to the right. So that's what I'm gonna do now. And the same thing with here. You see a little zone going upwards, a resistance area, and you would draw that same thing up here. So what would you do? You would wait for the market to break this resistance area, and you would enter on the support going long in the up direction. So this could be one of your potential trades right over here. And same thing up here. This was a resistance area. You patiently wait for the price action to pierce this zone, and once it does, you wait and look for a potential area to go long once the price kind of touches back at that same area. So we're waiting, we go up, and we're waiting for the market to come down, and once it does, we go ahead and enter our trade in the long direction. So that was kind of the strategy that I kind of explained. So now let's kind of go back to where we are right now. So you see this same little peak here. We're doing the same thing over and over and over again. We draw that same little zone, and we wait to find our entry once the price eventually ends up breaking this highest part, and we wait until the price comes back to it and touches it, and we enter our trade here. Now, in another video, I was discussing different candlestick patterns. You'll notice this created a hammer candle. If you haven't watched that video, I'll link it right up there as well because it's super important. So let's say you notice that the price broke and retested it, and you saw this candle formation here. So you're looking to go long, right? So you're looking to enter right at the end of this little candle here. So you enter your trade here, and here is how you would calculate, based on specific trades, how you would use leverage in your favor to make sure that you're trading the correct way. So here's how you need to think about it. So first, as we mentioned, we have a $1,000 account. We're willing to risk 20 bucks, 2%, right? So now we need to determine how far must the price go in order for us to be okay with losing that 20 bucks. So let's say, just for simple math's sake, that you say 20 pips. So you're saying if the price goes 20 pips against me, I'm willing to lose the $20. And anything on the upside, I'm willing to make that money on the upside. So if you think about it, with a 20 pip stop loss, and we're willing to risk 20 bucks, if you think about what I mentioned in the beginning of the video, you have the $20 as collateral that you're willing to put up. How much money will a broker be able to trade for you? $20 times the 500 leverage. How much money is that? That's $10,000. So that would be you entering a $10,000 position, not a $500,000 position as I mentioned in the previous example. So you would enter a $10,000 position by only putting up collateral 20 bucks. And if you recall from the video where I explained lot sizes in pips, a $10,000 position, a lot size of 0.1, you're going to be making or losing $1 per pip. So can we agree, if we're losing $1 per pip and it goes against us by 20 pips, how much money have we lost? 20 pips times $1, we've lost 20 bucks. That's how you kind of do the math and understand that, okay, I'm willing to lose 2%, 20 bucks based on that lot size. That's how you calculate it. So let's just assume another example. Let's say instead you weren't comfortable with the 20 pip stop loss. Maybe that was just a little bit too close for your taste. So let's just say that you wanted to do a 40 pip stop loss. So remember, we're still willing to only lose the $20. So how would we calculate this? We would calculate this by saying, okay, $20 I'm willing to risk for 40 pips worth. So $20 divided by 40 pips, that's going to get us 50 cents per pip for this trade. 50 cents per pip. Not $1, but 50 cents per pip. So what would our lot size be? What would our trade size be in this case? It wouldn't be 10,000 units this time. It would be 5,000 units. So in this case, if the broker is going to be able to front us 5,000 units, and remember, they're giving us 500 leverage, so how much capital do we need to put up for this trade? We would just take that 500 units and we would just divide that by 500 because we need to put up only 1/500th of that. And if you do the math, you'll notice that for this trade, we only need to put up $10 to enter that 5,000 unit trade. So now we have a 5,000 unit trade, which we're going to be making or losing 50 cents per pip. So if this trade goes against us by these 40 pips, we've lost $20. And if this trade goes in our favor, we made X amount of money depending on how high we want to hold our trade open for. So think about it. In the first example, the wrong way to do it, you could literally blow your account with just one trade. And in this example, we've entered, for example, let's say we entered both of these two examples, the 40 pip stop loss and the 20 pip stop loss. Let's just say we entered both of those. If we got both of them wrong, we only lose 4% of our account. We lose 2% for the first trade and we lose 2% for the second trade. Our account lives to see another day. So in this case, yes, you still do have that $500,000 worth of buying power, but of course you're not going to use all of that. You're going to use small increments. You're going to use 10,000 here, right? You're going to use 5,000 there. You use small increments to make sure that if you lose here and there, you're not going to completely blow your account. And if you do get your trades right, that $500,000 of buying power, that will exponentially increase as you continue to get your trades correct. Because in that first example, if you entered that one trade with your whole account balance, you wouldn't be able to enter another trade. It just wouldn't let you. Your broker would just say not enough margin. But here, since we're entering small trades, we can enter 4, 5, 6, 7, 8, 20 different trades simultaneously at the same exact time, and we would still have plenty of room out of that $500,000 that we haven't used yet. And it doesn't matter if you're entering 20 trades as at a time, as long as each one of those trades have a very specific valid reason as to why you want to enter that trade. That's completely acceptable as well, because you know each trade that you lose, you're losing 2%. Each trade that you win, you could be gaining 2% or 3% or 5%, depending on what your risk to reward ratio is set for those individual specific trades. So one last example, just to fully wrap your head around this, is let's say you had a broker that only gave you 1 to 50 leverage. I want you to truly understand the difference between 1 to 500 and 1 to 50, so you guys can do the math based on whatever your broker gives you. So if this was 1 to 50 leverage instead of 1 to 500, the same concept. Let's say you had a trade with a 20 pip stop loss. Same concept. You're willing to lose 2% of your account, $1,000. 2% of that is 20 bucks, and your stop loss is 20 pips. So you're thinking $20 divided by 20 pips is going to make me or lose me how much money per pip? That's $1 per pip. Same thing as the previous example. You're still making or losing $1 per pip. So if you do the math, if you remember from the other video that I posted, $1 per pip, what's that lot size? The lot size for $1 per pip is 10,000 units. So in order for you to enter this trade, the broker would need to trade 10,000 units for you, right? So think about it. You have a $1,000 account and you have 1 to 50 leverage. Meaning every dollar that you have, the broker will front you 50 times that. So how much buying power in this case do you have? You have a total buying power of 50,000 units compared to the 500,000 units that you had with 1 to 500. So with 50,000 units of buying power, do you have enough buying power to enter this trade at 10,000 units? Yes, you do. You're using 10,000 units out of your 50,000 units. So yes, you can enter the same exact trade. Everything is the exact same if you're using your money management, your risk management properly. So what if you wanted to enter another trade, which was that 40 pip stop loss? It's the same thing. This trade will still need 5,000 units to be able to enter this trade. So in this case, you're using 5,000 units plus your other trade, which was 10,000 units. So you've now used up 15,000 units out of your total buying power of 50,000. So the only difference is the higher leverage that you get just allows you to enter more trades simultaneously. And with a proper trading plan, you're not going to want to enter 20, 30, 40, 50 trades at the same exact time anyways. So for a regular 1 to 50 leverage account, this really shouldn't be too much of an issue. It only becomes an issue if you're risking 5% of your account in a trade, 10% of your account in a trade, and you want to enter 5 trades at the same exact time. That's over risking in the first place. That's over leveraging, and you shouldn't be doing that in the first place at all. So if you're trading with the right proper risk management, leverage itself, 1 to 50 or 1 to 500, shouldn't really make a difference for you regardless. So I hope this was a very clear example on how to use leverage to your advantage the correct way. And hopefully this allows you to understand which way you should not use leverage. Because I've seen people use all of the leverage on one trade and they just blow their account. And I'm like, boy, if you don't get... Hopefully that was a clear explanation. I really genuinely do hope that you guys use leverage the correct way and do not over risk. That's the main thing. Always make sure that you're using proper risk and equity management in mind. Drop a like, subscribe if you haven't, and hit the notification bell if you haven't already, and I'll talk to you guys next time. Take care, guys.